Most people think investing is something you do after you're rich. That's the lie. Because if you don't invest, you're still playing a financial game. You're just losing it quietly. Right now. Not because you're lazy, not because you're bad with money, but because every dollar that sits still is being taxed by forces you don't see, you don't vote on, and you can't opt out of. Time, inflation, and a system that rewards ownership more than effort. So the real question is, what is investing? It's why were the rules written so that not investing is one of the riskiest moves you can make. And once you see it, you can't unsee it. Not investing is still a decision. Quick note before we start, this is education, not financial advice. Investing involves risk, including losing money. I'm not telling you what to buy, this is about understanding the game. Now, when people hear investing, they picture stock tickers, shouting traders, crypto charts, someone screaming buy the dip. That's noise. At its core, investing is simple. Investing is delaying consumption today so your money can produce more money tomorrow. You give up spending now, in exchange for ownership of something that can grow, compound, or generate cash over time. That something might be a business, real estate, a loan that earns interest, or a broad slice of the global economy. Saving, on the other hand, is defensive. Investing is offensive. Saving protects money. Investing puts money to work. And in today's world, that difference matters. Here's the setup nobody explains clearly. Wages tend to grow slowly. Prices tend to rise steadily. And productive assets can grow faster over long periods, especially when reinvested. This isn't a conspiracy theory, it's how modern economies function. If you only rely on wages, you're on a treadmill. If you only save cash, you're in a slow leak. And if you own productive assets long enough, you get access to compounding. Now, did anyone actually teach you this in school? Or did they just say, work hard, save your money, and you'll be fine? Because save your money is good advice for short-term stability. But save only is often a long-term losing strategy. Let's talk about quiet math. If inflation averages 3% per year and your savings earns 0.1%, your money loses purchasing power every year. It doesn't vanish, it just buys less. And the danger is that it's subtle. Losing 3% in a single day would feel like an emergency. Losing 3% every year feels like nothing. Until 10 years pass and you realize you're safe, savings don't cover what you thought they would. This is why people say, I don't invest because it's risky. But what that often really means is, I'm choosing a risk I can't see. Inflation risk, opportunity cost, the risk of standing still while the world moves forward. If you want more explainers like this, no hype, just clarity, subscribe. That's the whole channel, making money concepts understandable without pretending there's a shortcut. So what can you actually invest in? At a high level, most investments fall into a few buckets. 1. Businesses, stocks. When you buy a stock, you're buying ownership in a company. Not a lottery ticket. Not a line on an app. Ownership. If that company grows profits over time, owners tend to benefit through price appreciation, dividends, or both. Now, a single stock is concentrated risk. One company can fail, one industry can get disrupted. That's why diversification matters. 2. Loans, bonds. Bonds are basically you lending money to a company or a government. You get paid interest, and usually you're taking less risk than owning stock. But you also usually get lower returns over the long run. Bonds can play a role of stability, especially for shorter timelines. 3. Real assets, real estate. Real estate has 2 main engines: potential price growth over time and rental income. But it also comes with real-world friction. Maintenance, vacancies, taxes, leverage, and the big one, illiquidity. You can't sell a kitchen the way you sell an ETF. 4. Cash and cash equivalents. Cash is useful, it's not bad. It's for flexibility and emergencies. But it's not designed to be your long-term growth engine. 5. Digital assets, optional high risk. Digital assets are real and they're not going away, but they're also volatile, hype-driven, and easy to misunderstand. For most beginners, if you touch this category at all, it should be with money you can truly afford to lose and after you've built a solid foundation. There's no best investment, only context. Your timeline, your goals, your risk tolerance, and your behavior matter more than what's trending. Now we hit a fork in the road. Active investing versus passive investing. Active investing is what movies show. Picking stocks, timing trades, trying to outsmart everyone else. Passive investing is boring on purpose. You buy the market, usually through index funds, and you let time do the heavy lifting. Here's the uncomfortable truth. Most active managers underperform their benchmarks over time after fees. This is tracked in reports like SBIVA. Not because they're stupid, because markets are brutally competitive and costs matter. Every trade has someone on the other side. And increasingly, that someone might be an institution with more data, faster execution, and a team of analysts. Passive investing wins by refusing the ego contest. It accepts that predicting the short term is incredibly hard. It instead bets on long-term economic growth. Quick break, this video is sponsored by Sponsor. I only work with sponsors that are aligned with education and transparency, not get-rich-quick promises. Sponsor is a tool that helps you learn the basics, track your investing plan / automate saving and budgeting with clear fees and straightforward info. If you want to check it out, the link is in the description, no pressure. Back to the most important part, what actually makes investing work. It's not secret knowledge. It's a combination of owning productive assets over a long period while controlling your own behavior. Because risk is just the price goes up and down. Risk has categories. Market risk, the whole market can drop. Inflation risk, cash loses purchasing power. Liquidity risk, you can't easily sell without a penalty. Sequence risk, bad timing early in retirement can hurt withdrawals. Behavioral risk, panic selling, trend chasing, over trading. Most beginners obsess over volatility, price swings, and ignore the bigger danger. Not owning productive assets long enough for compounding to do its job. This is why time in the market is a cliché that survives, because it's true often enough to matter. A 7% annual return doesn't sound exciting. But over long periods, it can double your money roughly every 10 years. Slow, then significant, then it was hard to stop. So what do you actually do with this practically? Here's a beginner-friendly order of operations. Build a basic emergency fund. Enough to avoid going into debt when life happens. Kill high-interest debt. If you're paying 20% interest, that's a guaranteed negative return. Use tax-advantaged accounts if available. US examples: 401k Roth IRA HSA. UK example: stocks and shares ISA. Other countries have their own equivalents, use them if you can. Start with diversified, low-cost index funds ETFs. Broad exposure, low fees, less complexity. Automate contributions. A small amount every month, increase over time, consistency beats intensity. If you want to explore individual stocks or higher-risk bets later, fine. But do it after your foundation is built and keep it a small slice. Investing doesn't guarantee wealth. It doesn't fix inequality. And it doesn't make the system fair. What it does is reveal the system. Ownership compounds faster than labor, and time favors capital. So the real question is whether investing is risky. It's whether not investing is a risk you can afford. If you want, comment on your age and what you think your first step should be: emergency fund, debt, or starting an index fund, and I'll tell you what I'd prioritize in general terms. And if you know someone who still thinks saving alone is enough, share this with them.